Hello, my name is Nicole, and this video is about the popular 112 options trading strategy. The 112 options trading strategy has become increasingly popular among the retail trading community due to several prominent trading services and Discord groups promoting it. However, this trade has also been a major pain point for many unsuspecting traders due to its inherent weaknesses and frequent misuse. By the end of this video, you'll understand exactly how it works, when to use it, and most importantly, the risks you need to know about how to avoid becoming another casualty. So the 112 strategy is a variation of a put ratio spread. The numbers 112 refer to the ratio of put contracts at different strikes. The common structure includes one long put debit spread that is often suggested to be 50 to 100 points wide, with the long put strike near the 15 to 20 delta. And this is coupled with two short naked puts, with the strikes positioned around 5 to 10 delta, which make them relatively far out of the money. It is marketed that the put debit spread will provide some downside protection to the two naked puts, in addition to creating a quote profit tent in the event of a sell off of the underlying. The naked short puts generate income from the premium sold, but create unlimited downside risk. As always, let's hop into a trading platform here to illustrate what we are talking about. And I'm in the tastytrade trading platform today, and I have ES populated, as that is the underlying most commonly used for this trading strategy. And we're going to select the August 29th, 2025 expiration cycle with 65 days until expiration. It's often suggested to stay within 60 to 150 days to expiration when trading these structures. So first, let's figure out what strikes we would like to use for our 100-point wide put debit spread. And it looks like the 5750 strike is sitting at a 20 delta. So we are going to purchase the 5750, 5650 put debit spread as part of this structure. And now let's figure out what we want to use for the strike of our naked puts. And the 5350 fits the bill with a negative delta of 8. And I'm going to sell two of those. And this is what the structure would look like for a one lot. We have a 97% probability of profit. We're bringing in a credit of $1,888. The delta is 0.12. Theta is positive 69. And the max profit on this trade is $6,887.50. And if we put this on, we would see a debit in our buying power of 14,868. So a lot of times traders like to look at a visual of how this trade will behave under different price scenarios, and that's what we're looking at here. The area shaded in green is what the trade would look like at expiration at these different price points. The orange line that slopes downward there represents the value of the spread theoretically based on price movements. And it's important to note that that does not reflect changes in implied volatility. So what we're looking at here is how the trade would perform both at expiration as well as in current time. And you can see that if the market sells off early in the trade, that trade will show significant losses. So let's talk about why the 112 strategy can be deceptive. The put debit spread makes this trade appear to be somewhat protected. And the 5 to 10 delta short puts seem like they're safely out of the money at the time of initiation. And visually, it looks like an unbalanced condor on the profit and loss diagrams. However, it's important to note that an unbalanced put condor is actually risk defined, where this particular trade is not. So this is another look at the visual. And once again, this visual similarity to safer strategies is deceptive and hides dangerous risk exposures for traders who are not paying attention to the theoretical profit and loss line, which is that orange line. So why is this trade so popular among retail traders? Well, it appears to offer attractive risk-reward profiles, and it looks like it provides downside protection, and it seems to have a wide profit zone. And frankly, I think that's why most people are attracted to this, is that big profit tent. It looks very appealing on these diagrams. So, what's the problem? Well, traders who promote and trade this strategy often do not understand the hidden Greek exposures. So, let's talk about these hidden Greek exposures, which are the real danger in this trade. First, negative vega, which is the foundation of risk. Let's review what vega is. Vega measures how much your options positions value changes for each 1% change in implied volatility. Long options have positive vega, which benefit from rising implied volatility, and short options have negative vega, and they are hurt by rising implied volatility. The 112 strategy has a vega problem. The net position is net short vega because you're selling two naked puts. The put debit spread provides some positive vega, but it's insufficient to offset a meaningful amount of short vega from the naked puts. And during times of market stress, implied volatility spikes dramatically, and the net short vega positions will experience large losses, the extent of which often surprises unsuspecting traders. And this is the primary driver of losses during times of market stress with this trade structure. Next, let's talk about negative VAMA. And let's review what VAMA is. VAMA measures how your vega changes as volatility changes. It's a second order Greek that shows vega acceleration. And the 112 strategy has a very strong negative VAMA position. As volatility increases, like during market crashes, your negative vega becomes even more negative. Your losses literally snowball and accelerate with each volatility spike. And this creates a feedback loop. Higher volatility equals more negative vega, which equals bigger losses, which equals more market stress, which leads to even higher volatility. And this can create exponentially escalating losses that can't be stopped once started. Next, let's talk about lambda, the leveraged multiplier effects. And let's review what lambda is. Lambda is also called elasticity and measures the percentage change in an options price for a 1% change in the underlying stock price. Unlike delta, which shows dollar changes, lambda shows leverage multiplier effects. And the formula for lambda is delta times the stock price, and then you take that value and you divide that by the option price. So let's talk about why lambda matters by reviewing a simple example. Let's say you have a stock with a price of $100 and you have an at-the-money call worth $5 and a delta of 0.5. So lambda is calculated as follows. You take the delta of 0.5 and you multiply that times the stock price, which in this example is 100, and you divide that value by $5, which is the worth of the call, and you get a value of 10. So this means that if the stock moves by 1%, or in this case $1, the option will move by 50 cents, which is about 10% of the option's value. This 10-time multiplier is the lambda effect. So let's talk about lambda behavior at different strikes. Deep in the money options have a low lambda around 1 to 2 times, and they move almost like the stock. At the money options have a moderate lambda, usually between 5 and 15 times, and are considered to be balanced leverage. And out of the money options have a very high lambda, generally 20 to 100 times, and represent very high leverage. So what's the 112 strategies lambda situation? Well, your short puts collectively have a higher lambda relative to your long puts, which have a much lower lambda. So when the market crashes and moves towards your short strikes, the short puts can gain value at 30 to 50 times leverage rate, while the long puts gain value at only 10 to 15 times leverage rate. So the mathematical mismatch creates accelerated losses. So basically the short puts gain value at a much higher rate than the long puts. And in this case, it's almost a moot point because the long puts are part of a put debit spread. So the volatility changes there are going to be muted anyway. Now let's talk about long VANA, dynamic risk shift. First, what is VANA? VANA measures how your delta changes when volatility changes. And it's somewhat of a cross Greek between delta and vega. When you have a positive VANA, rising volatility makes your delta more positive. And when you have a negative VANA, rising volatility makes your delta more negative. So how does VANA hurt you in the 112 strategy? Well, the 112 strategy has a long VANA position. So as volatility increases during market stress, your delta increases and becomes more directionally exposed. In other words, your long exposure grows. So let's hop into the Thinkorswim trading platform here to see how a 112 trade structure would have fared during April of 2025. And you can see that was a time of major market stress as the Trump administration pursued its tariff policy. So I am going to look at the March OPEX, which is on the 21st, and I'm going to select the Monday following that options expiration as a day that many traders would have entered into this position mechanically. So I'm going to select the May 30th, 2025 expiration cycle with 67 days left to expiration. And let's figure out what strikes we would use for a 10-point wide put debit spread. And we're going 10 points wide because we're trading SPY and not ES or SPX in this example. So because we're trading SPY, the numbers are a little bit different, and this would be representative of a 100-point wide put debit spread in ES or SPX. So we've got that populated, and that put debit spread would cost us $1.39. And if we go down to the 500 strike put options, we can see that that has a delta of 7, which meets the generally suggested criteria. And I'm going to go ahead and I'm going to purchase 5 put debit spreads. I'm going to sell 10 naked puts. And this is going to mimic a 112 spread in ES. So this is essentially the same trade. So let's first calculate how much it would cost us to purchase the 5 put debit spreads, and that would cost $695. And next, let's calculate the net credit we'd receive by selling the 10 naked puts, and that would be $1,825. And we're going to subtract the $695 from that value, and this trade would bring in a net credit of $1,130. And the max profit of this trade is going to be $6,130, and I get that by taking the credit of $1,130 plus the max profit for the 5 put debit spreads, which would be $5,000. Now let's see how this trade would have performed through the end of March and into the first part of April. And I'm going to highlight here the profit and loss area for these positions. And as we move through the end of March, you can see there's not much going on with the positions. You see some weakness there on March 31st. And you see a little bit more weakness as we move into that first week of April. But overall, not much happening. And as of Friday, April 4th, we can see the losses starting to accelerate. April 7th here, we can see the losses are growing even more. And they're basically going to max out here on April 9th of 2025. So we can see that as the selling accelerated and implied volatility increased after the announcement of the tariffs, this position was showing a large unrealized net loss to the tune of $23,340. So remember, we only brought in a credit of $1,130, and to see a net loss on that trade of over $23,000 is fairly significant. And there were times probably during the course of overnight trading, if you were in ES, that those numbers looked even worse because liquidity was an issue and a lot was happening in the overnight sessions. And if you're in a cash product like SPY, you're not able to make any adjustments. So you can have large price gaps from the overnight trading sessions, and you are unable to execute any stop loss orders or anything like that until the cash open the next day. So that can be very problematic with this trade. Next, let's take a look at how the 112 structure fared during August of 2024. And you can see here that we did have a brief selling event that happened in early August of 2024. And that selling event doesn't look nearly as dramatic as the one that took place in April of 2025, but traders who are around know that the volatility spike was fairly violent, causing major losses for some options traders. You can see here with that VX overlay in the chart there that volatility went from a fairly low level to a pretty high level in short order. So we're back into the Think Back tab, and I'm going to do the same thing. I went to the July option expiration, which was July 19th, and I'm going to select the Monday after that as a day that many traders would probably have been executing new orders for the 112 trade structure. And I'm going to open the September 20th, 2024 option expiration cycle with 60 days to expiration to keep things somewhat consistent. And we're going to buy a 10-point wide put debit spread with the strikes at 530 and 520. And this time we're going to sell the 505 strike puts with a delta of 9. And we're going to sell 10 of those, and we're going to buy 5 of the put debit spreads. And we're going to calculate what kind of a debit we needed to cough up for the put debit spreads, and it would be $557.50. And when we factor in the net credit of $1,880, and we subtract the $557.50 from that value, we're going to get a net credit of $1,322.50. So that's the net credit that this position would have brought in at the time of initiation. And this has a max profit of $6,322.50. And I got that by taking the max profit from the put debit spreads, which is equal to $1,000, and adding the credit to that. So let's now take this trade through the end of July and into early August to see how this trade fared. So at the end of July, there's not much going on here. You can see some weakness in the trade, but nothing alarming. It's just kind of bouncing around like you would expect. And heading into late July, we're starting to see some weakness in the trade. And as of August 1st, nothing doing. And August 2nd, a little bit of weakness. And August 5th, boom. You can see a dramatic change in the P&L of the overall structure. And you're looking at over an $11,000 unrealized loss. And if you were trading during this time, you'll remember that most of those losses happened during the overnight trading session. So if we go back here to the 5th and 6th, a trader would have had no ability to make any adjustments if they were in a cash product like SPY, because a lot of the weakness that took place and the jump in implied volatility happened in the overnight trading session. So any ability to honor any stop losses would have been very difficult in this scenario as well. So this is what a one lot would have done if you had been trading ES or a 5510 in SPY. And what's interesting is a lot of traders trade much bigger in order to reach their portfolio metric goals. So a lot of traders would have had upwards of 10 or more contracts on, and that would be an overnight loss of $115,280 if you'd have been carrying that kind of size. So definitely some risk exposure demonstrated here. And now finally, I want to take a look at the risk analysis software in the thinkorswim trading platform if we were to put a position on today in this trading product here. So I have ES populated, and let's go ahead and purchase the 100-point wide put debit spread with the strikes at 5,700, 5,600. And let's go down and figure out what strike puts we would be selling. And the 5150 strike puts look attractive with a -7 delta here. That trade would bring in a credit of $1,952 with a max profit of $6,962.50. And let's analyze this trade to see what it would look like under times of market stress. So first, we're just going to highlight the middle section here of the risk array. And we can see that at the time of initiation, the delta would be a +5, the gamma would be a -0.01. This structure would have a positive theta of 57 and a negative vega of -359. And the margin requirement for this trade at initiation would be 15,524. And one thing I want to just talk about here is the recommendations for buying power usage with this. A lot of times, some of these Discord groups and services will recommend anywhere between 25 to 50% buying power usage in strategies like this. And what I'm calculating here is if this was a $500,000 account, if I were to allocate 25% of my available buying power based on the margin requirements right now during calm times, I would be allowed to put on up to 8 lots of this trade. So I could do this times 8 spread out throughout different expirations. And we can see here that if volatility jumped by 25%, which is what happened in the previous 2 examples that we just went over, this trade would show very negative profits. And in this software, it's showing margin requirements having very little change. And I can guarantee you that that is not the case. During times of market stress, span margin changes significantly. And that's what you use when you trade ES futures options. And a lot of times people get into margin problems and they are forced to close trades as a result at the very worst possible time. And so you can see here just what one position would do from a P&L perspective based on a 25% volatility jump. And again, that's what we saw in April as well as in August. And if I would have a 2 lot on of this position, you can see how that would really influence the profit and loss in this position. If I would have had a 3 lot on, a 336 in these ES futures options, you can see how devastating that might have been. And that's just with the 3 lot. That doesn't include having up to 8 of these positions on spread out through different expirations. And people who would argue this point with me would say, well, some of these expirations would be spread out and be nearer to the expiration, so the pain wouldn't be as dramatic. And to that I say, you're just simply wrong. Once these implied volatilities blow out and margin requirements jump, it can be very painful regardless of what expiration you're in. So let's talk about why traditional risk management fails. First, you have the illusion of protection. The strategy appears to have built-in protection, and visual profit loss diagrams are misleading. And analysis is done statically and doesn't account for dynamic Greek behavior. Next, you have margin expansion problems. Margin requirements increase dramatically during market stress. And this forces early exits at worst possible times and creates liquidity crises when you're already losing money. And this can make filling stop loss orders very, very difficult. And finally, the speed factor. Modern market crashes happen faster than ever with amplified volatility spikes, and traders have no time to adjust or manage these positions. Now let's talk about some basic risk management rules. First, never risk more than 1 to 2% of an account on any single trade. And make sure you understand all Greek exposures before trading any single strategy. Stress test strategies against historical extreme moves and pay attention to those results. Don't just assume that those extreme moves will never happen again. And have exit plans before entering trades. And finally, if you're working with a mentor or a trading service and you have questions about risk, be sure to get answers. Do not settle for dismissiveness. This is a red flag and should be taken very seriously. Now let's talk about some key takeaways. The 1-1-2 strategy is a popular trading strategy with hidden risks that are often not appreciated. Greek exposures can create feedback loops of escalating losses during times of market stress, and account wipeouts can happen in days, not months. Never allocate significant capital to strategies you don't fully understand, and always understand Greek exposures. If you do decide to proceed with trading the 1-1-2 strategy, please keep your size appropriate and be strategic. If you found this video helpful, please like, share, and subscribe. Please drop any comments that you might have in the comment section below. And as always, be awesome.